In this video, we'll illustrate the essentials of how accounting tracks a company's activities and how this allows us to produce basic financial statements. Jane, Alan and Colin are three friends who've just graduated from a renowned business school. They decide to put theory into practice by starting a business. They prefer to keep their business model uncomplicated and decide to focus on buying and selling second-hand cars. They seek the advice of a solicitor and register a limited legal liability company with Jane, Alan and Colin appointed as main owner shareholders. They call their company Reliable Runner Limited. We will track Reliable Runner's transactions in the accounting system and show how this will enable the owners to produce basic financial statements. To monitor business transactions in the accounting system, we will not use technical accounting entries with debits and credits that one would encounter in a traditional accounting environment. We will use a spreadsheet-like format to illustrate the logic of how an accounting system works. Concurrently, we'll show on the left-hand side of the display a preview of how the transactions would affect a balance sheet. In the spreadsheet, the upper part shows the assets, while the lower part shows liabilities and owner's equity. The balance sheet equation demands that the sum of all assets should always be equal to the sum of owner's equity and liabilities. Each new transaction will be reflected in a separate spreadsheet column. Each transaction should be accounted for in such a way that its effect on the upper part is equal to its effect on the lower part. This will preserve the balance sheet equation and should be checked for each transaction. Now let's have a look at the first accounting transaction, funding the company with share capital. Setting up a legal entity allows our friends to separate their personal funds from those of their company. They open a bank account in the name of Reliable Runner Limited. From their personal savings, Jane puts in €20,000, Alan $15,000 and Colin $15,000. They transfer these amounts from their personal bank accounts to the company account. The owner's personal cash assets will decrease and those of the company will increase. Note that in the spreadsheet we only present the effect on the assets of the company, not on those of the owners. After transferring the funds, the company's resources will be €50,000 in cash, financed by share capital or owner's equity. Thus, the initial funding transaction will create an equal increase of total assets and of the sum of owner's equity and liabilities by €50,000. At business school, our friends learned how to write a proper business plan, and they've come to the conclusion that their shareholder funds will not be sufficient to get their business up and running. To secure extra funding, they negotiate with a local bank to get some debt financing. They manage to convince the bank manager of the value of their business plan and obtain a bank loan for €30,000 to be repaid in 3 years' time. Assuming this money is put into the company's bank account, we see an increase in cash resources and an increase in financing. But here it is long-term debt financing. The company now has total assets, all cash, of €80,000, while it has equity of €50,000 and liabilities of €30,000. Next, the friends acquire a garage with an office for €55,000 in cash. Until now, we've been looking at transactions that have affected both sides of the balance sheet equation, but this new transaction will affect one side only. In fact, the company is exchanging one asset, cash, for another asset, property. The total value of the company's resources will remain the same, but the way the value is categorized will be different. So, this transaction will not affect the financing side of the spreadsheet. Reliable Runner now has assets worth €80,000 in the form of property and cash, while it has liabilities of €30,000 bank loan and equity of €50,000 share capital. The Friends' next move is to acquire some inventory for trading. The company buys 4 second-hand cars for a total of €18,000 cash. Here again, there is a swap between cash assets and other forms of asset, this time a current asset, inventory. It's assumed in accounting that inventories will be sold within less than 1 year, so inventory is treated as a current asset and recorded at its original cost. Reliable Runner is now ready to start convincing customers and selling cars. Our friends are now eager to find out what their current financial position is. Assuming that the transactions up to now all took place in period A, they can see the information on the statement of financial position for period A. As the balance sheet equation is respected for each transaction, one can, in principle, draw up a balance sheet after each move, and in fact, that is what is shown in the preview displays of the balance sheet. In practice, however, a balance sheet is only drawn up periodically. The accounting system will produce an intermediate balance sheet by simply pushing a button. This will start a process of calculating the balances of each item in the spreadsheet. Each item represents an account. These account balances can be reordered and relabeled in a preferred balance sheet presentation. This intermediate position tracking will provide the following balance sheet. Up to now, in period A, we've accounted for a number of business transactions. 1. The setting up of Reliable Runner Limited, with share capital and a bank loan as its initial sources of finance. 2. The use of some of the cash received through these 2 financing operations to invest in a garage with an office. And 3. The use of some of the cash received through these 2 financing operations to acquire an inventory of second-hand cars to sell. Following this, we have drawn up a balance sheet dated end of period A. As the company has not yet delivered goods or services to third parties, there are no profits nor losses to show in this period, so no statement of profit or loss needs to be generated. Now we come to period B, in which Reliable Runner starts selling cars, hopefully with a profit. We'll follow a number of operating transactions during this period and monitor how these affect Reliable Runner's trading or financial performance, its profit or loss. We will also check how these transactions affect the company's cash position. We will therefore generate a statement of profit or loss for period B and a statement of financial position, balance sheet, at the end of period B. We will assume that should there be any profits, they will not be distributed to shareholders as a dividend, but instead retained in the company, within owner's equity to finance the company's future growth. As the shareholders are the ultimate beneficiaries of any profits or losses, trading activities will have the effect of increasing or decreasing owner's equity. This worked example explicitly follows this logic by directly logging components of profit or loss within equity, with revenue from sales increasing equity and expenses decreasing equity. A separate statement of profit or loss would provide us with an overview of all income and expense items accounted for within equity. The financial position at the end of period A will be the starting financial position for period B. Let's assume a first car is sold for €5,000 cash. The sale will be recognised as revenue. This increases profit and, thus, the value of the owner's equity, while the cash received increases the assets of the company. However, we also have to record the other side of the exchange transaction, the fact that we've given up part of our inventory. For Reliable Runner Limited, the car inventory represents an economic value of which the benefits will be consumed in the future when the cars are sold. Inventory remains on the balance sheet until it's consumed, and that is what has now happened with the car sale. An asset has been consumed and turned into an expense. We need to record the reduction of the inventory asset by one vehicle. We've gained a cash asset of €5,000, but we've given up a car asset which had, let's assume, previously been bought for €4,000, an amount included in our initial inventory of €18,000. The real effect of the transaction is to create a net profit of €1,000, and this is reflected in the accounts by offsetting the inventory against the sale. We cancel the inventory value of the car sold by deducting this from the sale. In the spreadsheet, we reduce inventory by €4,000 and reduce profit by €4,000. Reducing the inventory, in fact, means that the company consumes part of its resources in the trading process. So, an asset becomes an expense when the economic benefits that it embodies are consumed. Let's also imagine that as the new owner of the car was test driving it, a wing mirror fell off. Reliable Runner Limited quickly arranged for a nearby repair shop to replace the mirror and carry out one or two other minor repairs, and they paid the repair shop €250 for this work. This expenditure would also be an expense, as the repair was deemed necessary to complete the sale. Now, suppose Reliable Runner sells another car, this time for €7,000, and allows the customer credit. The company delivers the car in exchange for a promise to receive payment in the future. The transaction would appear in the balance sheet as an increase in equity and an increase in a new form of current asset, a receivable. This is a promise to receive payment at a later date and is just as valuable as cash, as long as you can expect the receivable to be paid. Let us say the original cost of the car sold was €5,500. Again, we reduce inventory by €5,500 and reduce profit by €5,500. After the second sale, only 2 cars remain in the company's inventory. So, the company now decides that it should expand its car inventory and purchases 2 more cars for €12,000, this time on credit. The company receives additional inventory for a commitment to pay for the cars at a later date. It will record an increase in assets, the additional car inventory, and an increase in financing, the short-term credit given by the supplier. In essence, this is a transaction very similar to the bank loan, with the difference being that the car finance is normally available only for a short period. Reaching the end of period B, we let the system recalculate all the company's account balances. The statement of profit or loss provides an overview of all revenue and expense items for the period. The statement of financial position, the balance sheet, at the end of period B would look like this. Note that at this point, neither the statement of profit or loss for period B or the balance sheet snapshot at the end of period B is complete. In the worked example, as you will no doubt have realised, a number of issues have been left out. For example, our three friends, the owner-shareholders, are probably quite busy with running the company, but they've not yet been remunerated for their work. If they arrange to receive a salary from the company, personnel expenses would appear. The garage has a finite useful life. Its economic value will be used up over time. Its future economic benefits will be gradually consumed by the business. Taking this into account will lead to what is called a depreciation expense. Reliable Runner will have to pay interest on the loan it received from the bank. This will lead to a periodic interest expense. And finally, taxes will have to be paid on the company's net profit, leading to a corporation or company tax expense. Please note that the increase in company cash during the trading period was €4,750, while the profit for that period was €2,250. This is generally the case in financial or accrual accounting, since we're trying to present an economic assessment, and while this translates itself into cash flows in the end, there are timing differences between the economic assessment and the underlying cash flows. In the worked example, we can reconcile the two as follows. The profit measure for period B takes into account two transactions that did not affect the net cash flow in this period. In period B, the second sale has not yet resulted in an incoming cash flow of €7,000, while the purchase of the two cars that were sold in period B had already been paid for before the start of period B. Correcting for these timing differences enables us to reconcile net cash flow and net profit for the period. These timing differences are called accruals and are typical for how financial accounting works. This is why we call financial accounting accrual accounting. You'll learn more about this in the next video. So, in this video, we've seen that the spreadsheet represents the company's accounting database. In reality, of course, this will consist of potentially hundreds of accounts that are constantly being updated as the accounting department tracks the company's transactions over time.